Hello and welcome back to Make Money Guide, where we give you tips, tricks and practical guides to make money. Investing in stocks is an excellent way to grow wealth. For long-term investors, stocks are a good investment even during periods of market volatility. A stock market downturn simply means that many stocks are on sale. Warren Buffett's investing principles have earned him the moniker of the world's greatest investor. It is a nickname that Buffett himself chuckles at, but when you are worth $36 billion, it's hard to dispute. However, it's not the truth. Buffett is still the chairman and CEO of Berkshire Hathaway at 89 years old. As of 2020, Warren Buffett has a net worth of $76 billion. Despite being very rich, Warren Buffett is known for being a philanthropist and gives away a lot of his money. Over the last 10 years, this has amounted to more than $27 billion. Today, we're going to be talking about how to invest for beginners. Make sure you subscribe to the channel and turn notices on so you don't miss any valuable content. Number 7, invest in what you know and understand. Buffett cautions that you should never invest in businesses that you don't fully understand. He says that if it becomes he invests stocks of a company, he has to first understand how the company makes money and the main drivers that impact its industry in no more than 10 minutes. If he's not able to understand it in 10 minutes, he moves on to evaluate another company on this basis. Did you hear about Warren Buffett buying weed stocks or getting into the hottest new cryptocurrency to hit the market? Probably not. Warren Buffett is known for investing in simple businesses. He invests in what he understands. Cryptocurrencies and weed stocks would fall short of a lot of Buffett's criteria, but the main point here is that he does not invest in something if he does not understand it. If you want to invest like the man himself, you should neither. Understanding something about the industries or companies you invest in will make it easier to stay current on industry trends and company news. An investing strategy based on hype or following other people's stock tips is a recipe for long-term failure. If you're interested in a company you do not know, but hear a lot about it, research it first. Most people can't predict the next fashion trend among teenagers or whether or not a medicine will be successful in the market. Even if you had more data than anyone else, it's still impossible to predict the future with 100% accuracy. In situations that rely on accurate forecasts of the future, Buffett advises not to invest. If it's complex for you, just look for other businesses to invest in. Buffett once said that out of about 10,000 publicly traded firms, he would like to invest in only a few hundred companies before even taking valuation into account. Number 6, understand price versus value. Price is what you pay. Value is what you get. Warren Buffett is a long-term investor. He invests in companies based on the underlying value of the shares. Determining the underlying or intrinsic value of stock is very difficult, which is why Buffett recommends that most people just invest in low-fee index funds. If you do want to learn about value investing, you should learn from the man who taught Warren Buffett. This was a man by the name of Benjamin Graham, mentor to Warren Buffett. In the book, The Intelligent Investor, Benjamin Graham teaches the principles of value investing. Before you run out and buy a copy, be forewarned that this book is over 600 pages long and was originally published in 1949. Despite the age of this book, the principles are still valuable and relevant. When it comes to investing in stocks, most people only focus on the price of a given stock. They look at market high flyers and try to get in on what is already taking off. However, very few actually take a step back and consider what the value is that they're actually getting. Once you've established your value investing criteria, it's time to make a list of stocks that fit your wish list. For example, let's say you want stocks that trade for less than 15 times earning and have a strong history of generating 20% returns on assets year after year. Most brokerage accounts offer screeners and other tools to make this process easier and will generate a list of stocks based on your criteria. Value investors do not invest in hype. They study the fundamentals, comb through financial documents, and buy shares of companies trading at or below intrinsic value. Most of the market high flyers and tech stocks trade at crazy high valuations that far exceed the value of the company assets. Number 5, investing is a long-term game. Once you have a list of stocks whose metrics look attractive, narrow it down by choosing businesses that will hold up well during recessions. This is why Buffett loves to invest in utilities. Eliminate businesses that are high dependent on a strong economy, such as retailers that sell discretionary or luxury products. Money doesn't grow overnight. By getting 9 women pregnant, you can't make a child in a month. No matter how good the talent or attempts are, Warren Buffett is just saying some things take time. Warren Buffett is a long-term investor. He patiently waits for investment opportunities, and once he buys shares, he rarely sells them. Some of Buffett's investments date back to the 1960s. Investment planning should be done by considering the long-term goals. Investor goes for futures and options with the hope of making quick money, but they are actually the ones who lose money. Stocks are long-term investment. The movement of the share price in the short term is unpredictable. Trying to bet on what will happen to a stock in the short term is near impossible. There are several things that can give a business an advantage, such as efficiency, scale, or proprietary technology. To give one example, Buffett's favorite Coca-Cola has an amazing distribution network, as well as an extremely valuable brand name that gives it pricing power. Number 4, pay attention to the management team. Warren Buffett spends a lot of time learning about the management team of a company. A good management team is characteristic of any company Buffett invests in. Buffett looks at how management treats shareholders, employees, customers, and even the environment. Above all else, he looks for management to be honest with the shareholders. Buffett looks at a number of factors, including share buybacks, dividends, dividend growth, and the overall company reputation. If management is acting responsibly, dividends should be paid on a regular basis with a long history of consistently raising that dividend. Shareholders should also be rewarded through a company-sponsored share buyback program. It's hard to put enough emphasis on the value Buffett places on good management. Buffett will invest in a stock only if he trusts management and thinks he'll continuously act in shareholders' best interest. Positive signs include a history of dividend growth and buybacks, both ways of returning capital to investors, and excellent reputations. Buffett often spends a considerable portion of his shareholder letter praising the leaders of Berkshire's subsidiaries, and he's bought and sold investments based on management's actions. If you want to invest like Warren Buffett, get to know the management. Read the annual reports, earnings reports, watch interviews, and study the career path of company management team. Do they have an outside hire? Where did they work before? Number 3, be aggressive during tough times. It's generally a bad idea to time the market. Long-term investors will probably do fine no matter when they buy. Yet it's still important to look for opportunities during tough economic times. We often tell people that one of the secrets of successful long-term investors is that they love market corrections as they offer the best opportunities. Some individuals are not supposed to own stocks at all because they are too annoyed by price changes. If you're going to do stupid things because your inventory is going down, you shouldn't own stock at all, Warren Buffett said during a CNBC interview. Some people aren't really mentally or psychologically fit for their own stock, but we believe more of them would be, Buffett said, if they were more informed about what they are actually purchasing, which is composed of a company. Buffett invests money in good times and bad, but he did a great job of capitalizing on opportunities during and shortly after the Great Recession, with savvy deals such as his Bank of America investment. Every decade or so, dark clouds will fill the economic skies and they will briefly rain gold, Buffett told shareholders in his latest annual letter. Number 2, sell at the right time. When a company no longer matches your reasons for buying, sell the stock. If you determined it needs to be above its 2-year average stock price and falls beneath it, then you sell. This is what most Buffett followers miss. He has rules and he diligently follows them. When a company no longer fits his criteria, he sells. Resist the urge to make excuses to stay in the investment. Sell it. Period. Number 1, trust yourself to be a successful investor. Warren Buffett says the hardest thing is to trust your investment decisions. You always think that others are right and you are wrong. Instead, you need to study and believe in yourself. I always knew I was going to be rich. I don't. I think I doubted for a minute, Warren Buffett. It is one of his most famous quotes. He says, "We've long felt the only value of stock forecasters is to make fortune tellers look good." Essentially, what he is getting at there is that their analysis say about markets and companies should be taken as seriously as a fortune from a fortune teller. So you don't see Warren Buffett buying and selling stocks based on these market forecasts. He conducts his own research and sticks to his strategy. To be successful, you need to overcome the fear and not pay attention to what others are telling you. Accumulate understanding and create investment choices to stand apart from the crowd and be a winner on your own. To be successful, you need to overcome the fear and not pay attention to what others are telling you. Accumulate knowledge and make investment decisions on your own to stand separate from the crowd and be a winner. We hope you enjoyed these investment tips from Warren Buffett, which can be followed by almost anyone to be a successful investor. You can take these investment tips and apply them to your own investing, whether you're a new investor or an experienced investor. While you are here, go ahead and click on one of these 2 videos on your screen. See you there.